projecting anywhere from 100,000 to 240,000 total deaths in the US. Big investors are weighing in on what's ahead. Double Line's Jeff Gundlach predicts the market will fall in April and take out the March lows. And Boston Fed President Eric Rosengren says the Fed needs to adapt as the crisis proceeds and that he expects the unemployment rate to rise dramatically.
We've got a big guest lineup coming for you in just a few minutes. We're going to talk to Morgan Stanley Chairman and CEO James Gorman. He'll join us live to talk about the market volatility and how the banks have fared so far in this crisis. Let's focus in on the big stories, though, that we are watching at this hour, the final hour of trade. Mike Santoli watching the market plunge. Steve Leisman has the latest from the Fed. Meg Terrell has new details on the state of virus testing in America, so important. Mike, though, first to you on this market. We're seeing pretty steep sell-off here into the close.
Yeah, it is a pretty steep sell-off, Sarah. And, you know, sad to say, not that unusual after you get one of these crash-like moves and then a rebound. I think a lot of folks were handicapping this would be an area where it would stall out. This may be a little more than a stall. We'll have to see. So this is a 2-year chart. Remember back here we were talking about those levels of late 2018. Maybe we were going to break them. Maybe they were going to hold. Well, they broke for sure. But we're kind of up in that same zone again. And you see this kind of rollover here of that rally. Now, I don't think we've necessarily completely given back whatever we had in terms of a panic selling moment and then a decent rebound. But it does seem as if we have a few percent to work with here before you can basically say, hey, that was just a mere dead cat bounce. We did not really pass many tests on the upside in terms of clearing various thresholds that folks were looking for. So that's something to keep in mind. Now, the credit side of things, obviously it has been calmed down a little bit by the Fed actions. This is the ETFs that track the high grade, high yield, and treasury markets. And you can see, obviously, this is the market lows for equities. That's when credit was at its worst. There was a nice strong rebound. We got some issuance going. Past couple of days, though, slight softening up. So that's the credit spreads are kind of moving back out in a soft way right now. So that's one of the reasons, along with treasury yields getting compressed even lower, that I do think you have a little more of a flight from risk today. Although I would say not really a headlong rush. It does seem to be just a little bit of a give back and some selling opportunities after that rally for now, sir.
It's nice to see you in front of a telestrator again, Mike.
It's good to be in front of one. Thank you, sir.
One part of the market that really stands out today in a bad way is the REITs, the real estate stocks. They're getting actually crushed right now, down more than 7%. And I guess the thinking here, Mike, is that, you know, short-term, long-term, if you're looking at the impact of all of this, one place that could be hurt is commercial real estate, whether it's office spaces, because everybody's working from home pretty efficiently, or malls, and the retailers are just going to face even more pain.
Well, think about the conversation today. April 1st, the rent is due. What's the main thrust of a lot of the voices that you hear right now is, don't pay the rent, I can't make the rent. Who's on the hook for that is the landlords. And that, along with some of these margin calls in leveraged commercial real estate securities, obviously is creating a little bit of pain in that area. So absolutely right. It's not as if everything was fixed with the Fed backstop and all the rest of it. It definitely did placate the markets for a little while, but I do think you're still going to have to deal with the wear and tear of what it means when we're starting running this kind of credit cycle in reverse in parts of the economy.
Mike, Sarah said it. It's good to see you in front of a telestrator. It's good to see you in person as well.
Yeah,
I want to remind you that nearly 3 weeks ago, we began issuing guidance, first around limiting the number of people in mass gatherings, then a few days later, issuing guidance to protect our vulnerable population.
That would mean, in the way many people think about it, an actual recession. He also had said initially in his opening remarks that he sees unemployment rising dramatically. During the Q&A, he did reveal that the Boston internal Fed forecast sees the unemployment rate topping 10%. I will tell you that I have seen Wall Street forecasters with numbers that are higher than that, maybe close to 15%. He's also worried about high yield and leveraged loans. If the crisis persists beyond, say, a couple quarters. He has some concern there as well. And he did talk about just what you guys were talking about, commercial real estate. Finally, Larry Summers, the former Treasury Secretary, now speaking at the Economic Club of New York, says he wouldn't be surprised, or he could see possibly GDP going down 50% in a single quarter. That would be among the higher forecasts that I have seen. He did say Congress and the Fed are off to a strong start, but went on to say that the biggest mistake, the greatest mistake that we could make would be to declare premature victory. He wants to be sure that we don't sound the all clear or the all clear before it's time that we have a relapse of this situation. He also said, guys, that he believes an equity stake should be taken in Boeing if the government provides it assistance. Wolf, Sarah?
Steve, on Rosengren, I mean, you, Sarah, and I, we all chatted with President Mester as well yesterday. How do you gauge how downbeat and bearish some of these officials are? Because I felt Mester yesterday was relatively encouraged or encouraging, despite, of course, acknowledging how difficult the situation is.
I don't hear anybody being either encouraging or discouraging, Wolf. I hear people just stating the facts as far as they can know them. I think, you know, it would be unusual for a Federal Reserve official to acknowledge that we're going to have a recession. In general, Fed officials can sort of, their policy must avert a recession. I think it's discouraging in the sense that I believe that the Fed thinks at this point they cannot avoid a recession, that what we're playing for here now is the cleanup. We're playing for the idea of having a fast rebound. We're playing for not having lasting damage done from the process of shutting down the economy to stop the spread of the virus. That's what's going on the fiscal side with the $2 trillion stimulus. That's what's going on the Fed side. It's trying to make this into the idling of productive capacity, not the shutting down of productive capacity. So I see them simply stating the facts here. Unemployment is going to be a mathematical equation eventually when the job counters catch up to what's actually going on in the jobs market. It won't show up, however, in the Friday jobs report.
Steve, thank you. Steve Leisman.
Pleasure.
The U.S. has now completed more than 1 million coronavirus tests, but states are still reporting shortages. Meg Terrell joins us with more on where we stand in testing. Meg, bring us up to speed.
Hey, Sarah. Well, that million test threshold has been passed this week, but that kind of obscures the difficulty we still have in getting a test in the U.S., and that really varies by which state you're in. Check out this map that shows the numbers of tests run on a per capita basis. The darker the state, the more the tests run. So no surprise, New York has run the most on a per capita basis, Washington State as well. Louisiana comes in third. It's run more than 40,000 tests. That's the third most per capita. Now, on the other end of that, those lighter colored states, Texas, South Carolina, California, Oklahoma, all doing pretty poorly when you look at it on a population basis. And California has a major backlog in tests. They report 57,000 tests pending in that state. So what is going on driving all of these backlogs? First, there's a shortage of supplies to run the tests and protective equipment for the people taking the samples. There was a backlog that was generated at the beginning before these labs really had the capacity. Tons of samples were coming in, so the backlogs just still exist. There's been a logistics slowdown in terms of fewer flights across the U.S. delivering these samples to the labs to process them. And Dr. Deborah Birx saying yesterday in the White House Coronavirus Task Force briefing that labs just send the samples to the places they're used to sending them. So even though there's new technology that's been improved, they're still sending them to the original places. So all of these things, guys, coming together to create quite a backlog. Back over to you.
So how do we read the curves? How do we make the curves? How do we understand what the actual mortality rate is if the data is so scarce because the tests are not happening at scale, Meg?
It's a great question. And in California in particular, we've been hearing that the curve might be starting to flatten. And experts there are saying you have to look at things like hospitalizations, deaths. Those are really concrete things that are being counted in order to know if they're really starting to flatten the curve and make a difference, as testing is so different in different parts of the country.
Meg Terrell, as always, thanks so much for that. We are down 4.6% on the S&P 500 with 50 minutes, 50 left of trade. Up next, President Trump planning to meet with oil executives on Friday as crude comes off its worst quarter ever We'll discuss the outlook and Middle East tensions with former Saudi Aramco executive Saad Al-Husseini. And our live interview with Morgan Stanley's James Gorman is just 15 minutes away. You don't want to miss that amid this market turmoil. We're back in a couple minutes.
Are you curious what others are listening to on TuneIn? Head to the trending section under Browse to see the most popular stations and podcasts among TuneIn listeners right now. Check it out. You might just discover something new for yourself.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know. It's TuneIn Sports on this day. April 1st, 1991, Duke beats Kansas to win their first men's basketball title. Power forward Christian Laettner was named the most outstanding player.
For Laettner. Sees Davis with Berry intercepts. Final seconds. Jordan got the jumper. It doesn't matter. Duke has won its first national championship.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wait a second.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building.
For these and more, search sports and scroll down to the world of wrestling.
The CNBC app.
I sent your new prescription to the pharmacy. Any idea how much it will cost? You have a choice. Insurance or GoodRx? I have insurance. Insurance is not what it used to be. People struggle to get their prescriptions covered, and prices keep rising. I recommend GoodRx. You get free coupons to save on your prescriptions. Compare prices to find the best discounts.
GoodRx. Smart.
Stop paying too much for your prescriptions. Download the free app today.
At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month.
Visit Credible.com to see how much you could save.
I got things I want to do, but student loans were holding me back. Credible.com helped me save $600 a month with a great rate. Now I can go do what I want to do.
Visit Credible.com to see how much you could save on your student loans.
Well, welcome back. Just over 45 minutes left of the session. Here's a check-in on the markets. As you can see, we've got the S&P down 4.6%. The Dow is close to 1,000 points lower. It's down 943 points, which is there or thereabouts at the session lows. All sectors lower, led lower by real estate, utilities, and financials, which, by the way, are also the worst performing three sectors for the week as a whole. Let's check in on some individual market movers. Quest Diagnostics stock has fallen today after it pulled its previous financial guidance for 2020. The medical lab operator said that even with a surge of COVID-19 testing, overall testing volume dropped more than 40% during the last 2 weeks of March. It's down 3.5%. And Macy's shares dropping, hitting levels not seen since the retailer re-emerged from bankruptcy as a public company in 1992. The fall came after S&P Dow Jones indices announced it's moving Macy's out of the S&P 500. It's down almost 8% today.
Oil staging a bit of a turnaround today, though coming off of its worst quarter on record. The biggest oil executives are heading to Washington to meet with President Trump on Friday as the demand drop has the industry reeling, not to mention the price war between Saudi Arabia and Russia. Joining us by phone now is Saad Al-Husseini, former Saudi Aramco executive vice president. Nice to speak to you again. What do you expect President Trump to do about this?
Well, good morning. I hope that he will listen because the oil executives are going to give him some numbers, and the numbers are going to surprise him from what I can see. The biggest oil importing source of oil for the U.S. is actually Canada, and the second highest is Mexico. These have nothing to do with OPEC. So if he will listen to them, then they will probably tell him that the U.S. imports a lot of oil and exports products. Imports 8 million barrels of oil and exports about 9 million barrels of products. So the trade is very important for the industry in the U.S. The U.S. production itself is very light oil, condensates, NGLs. They're not good for producing the exported products. So I hope he will be listening to them because they have, I'm sure, some very stark numbers for him.
But Sadat, clearly there is always a global price for oil, and that's what's putting pressure on U.S. producers at the moment. What ultimately do you think is the incentive of the Saudis at the moment? Is it to temporarily keep prices down so that in due course OPEC and Russia cut production to put prices meaningfully back up again? Or do you think the Saudis really are trying to put large swathes of U.S. production and other global producers out of business for the long term?
Well, very important points. This is a worldwide issue. It's not about the U.S. It's not about Saudi Arabia or Russia. Oil demand has collapsed, basically. We're looking, a lot of consultants have different numbers, but we're looking at about 15 million barrels loss of demand. So when you have numbers like that, there isn't any single country that can fix that problem. This requires a collective cooperation from all the major producers plus others. And the only way to separate which fields and which production should be continuing on beyond this crisis and which ones should not, should be the economics. The main criterion that can be applied worldwide is basic economics. If you put a ceiling of about $40 or $45 for production, any oil that is above that cost should probably be mothballed or shut down until we get through this crisis, because nobody can fix a loss of demand of 15 million barrels in this very tragic situation, which is not even controlled by economics. It's all by the pandemic of the coronavirus. Anyway, I think this is what everybody is hoping to achieve.
Sorry to cut you off, but obviously the demand drop-off is a huge driver right now, and the coronavirus is taking a huge toll economically. But, I mean, even the Saudis have come out and said they are increasing their production here, and we've seen this price war between Saudi Arabia and Russia. Are you suggesting that that's not having an impact on the price of oil?
What I'm saying is there are several points, but what I'm saying is it's not about the oil war or any oil kind of confrontation between countries. The markets cannot handle the amount of oil that's out there, and the Saudi oil is the cheapest, least costly oil. Now, we've tried to work with every country in OPEC and outside of OPEC, and I'm just a consultant, so I'm just following all of this, and I can see that there hasn't been any response. Even now, when the U.S. Looks at the oil problem, they consider everybody else's oil as being somehow invading U.S. markets. It's not like that. The U.S. consumes 21 million barrels and only produces 13. So it's not as if people are taking market share or trying to underprice U.S. oil. It's a collective market. Everybody, the high-cost oil, has to come out of the market. That's the only way we can drop 15 million barrels.
I mean, still, it's certainly out there. And, a senator from Alaska this morning on Squawk Box said that this could actually jeopardize our strategic relationship, the U.S. and Saudi Arabia, if Trump, wants to put pressure on the Saudis. How ultimately do you think this is going to reshape the geopolitical landscape, U.S. and Saudi Arabia, U.S. and Russia, and then OPEC versus Russia? Can anybody make a deal with each other here?
I wish it was as simple as making deals. There's a global demand issue and a global economic recession, and the only way that we can fix the markets is by restoring global growth, economic growth. The strategic issues, everybody has the same objective, economic welfare of the world. Nobody's trying to undermine anybody. The relationships are all healthy between Saudi Arabia and the U.S. for sure, between Russia and Saudi Arabia. There's no issues. It's not a strategic confrontation. It's an attempt to collectively resolve the economic problems of the world. And cheap oil, by the way, is the only way to go. Right after this crisis, that's what everybody's going to look for. And even the U.S. has fantastic opportunities But the more expensive marginal oil everywhere, whether it's in the U.S. or Russia or in Saudi Arabia even, will be shut down.
Sadat Al-Husseini, thank you so much for phoning in. We appreciate the perspective. We've got just about 40 minutes left here of trade. Take a look at the major averages. They are slumping pretty sharply here on the first day of the second quarter. We're looking at near session lows with the Dow down 953 points. The S&P is down 4.6%. Every sector is in the red, and those defensive yield plays like REITs and utilities, they're getting hit the hardest. Consumer staples doing the least worse. Coming up, Morgan Stanley CEO James Gorman joins us to break down this volatile trading environment. We'll be right back.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know. It's TuneIn Sports on this day, March 27th, 1988. The Chicago Bulls and Atlanta Hawks match up in the Georgia Dome in Atlanta. Now, it draws a crowd of 62,046, the largest in any game in the NBA history. And the Bulls win 89-74.
Well, there's no question the spotlight today will focus on Dominique. Given what happened last week, I would think there's some incentive for Dominique
to listen to conversations breaking down the moments just like this. Click on Sports to be part of the discussion on TuneIn.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. 20 seconds.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building.
For these and more, search sports and scroll down to the world of wrestling.
A doubleheader of legendary Sunday night football games every night of the week.
That may be the greatest catch I've ever seen.
Football Week in America. Every night this week on NBCSN.
Welcome back. 37 minutes left of trade. Help may soon be on the way for some of the hardest hit companies in this crisis. The Treasury Department releasing new guidelines for small business relief loans. Our Kate Rogers has the details. Kate.
Hey, Sarah. Well, those loans will be available beginning Friday, and senior administration officials say that the capital could be in the hands of small businesses as soon as same day. So here's how it's going to work. The SBA is currently working on a portal where small business owners can find lenders that are in their area. That's if they don't already have an existing banking relationship. Then they'd seemingly apply online through that bank. The SBA is also broadening out the rules about who can lend to include any FDIC-insured bank or credit union that enrolls in the program. These loans are going to have 0.5% interest rates for a 2-year term. Payments will be deferred for 6 months. And there is loan forgiveness available if employees are either retained or rehired, and the loan is used for certain expenses like payroll and rent or utilities. These loans will also be available on a first-come, first-served basis, and demand, as you can imagine, is likely going to be very high, which raises a lot of questions about available capital, particularly for sole proprietors and independent contractors who will have to wait until April 10th in order to apply for these. An important note here, guys, is that we've heard now from Treasury Secretary Steven Mnuchin saying that if the $349 billion runs out, he does plan to go back to Congress to ask for more aid. Another important note here, this is typically a $20 billion a year program that's ramping up to a $350 billion a year program in just a matter of weeks, guys. So the pressure's certainly on across the board. Back over to you.
It certainly is, Kate, and it's good to hear that there's more capacity potentially to come, because my bank sources expect the full $350 billion to be taken, if not on day one, then on week one. The banks frame this as the most insane mad scramble to be ready for Friday as they've ever had to face. They only saw the guidance from Treasury when we all saw it yesterday, and they're still waiting for other certain key details from the SBA and from Treasury. Despite that, a few of the large banks I've spoken to say they should be ready to take requests by 12:01 a.m. on Friday for the majority of their clients. But that's key, only for their existing clients. And also, as you mentioned, it will all be online. The money should then reach borrowers within 24 hours if all the tech platforms that are still being built process the applications smoothly. The banks will be a conduit for the loan, which is underwritten by the government, and at that point, the bank will receive a one-time processing fee, which ranges between 1% to 5% of the loan, depending on the size. No interest is due if it's forgiven in that 60-day period. If not, as you said, Kate, 0.5% becomes the interest rate. The fees, therefore, are low, but in total, the industry will receive billions of dollars of fees despite taking no credit risks themselves. No doubt this will lead to some criticism in the weeks and months ahead, especially if there are any hurdles in getting money to certain small companies that need it most. But the banks didn't ask for this, and they're also building out the pipes in an unprecedented way to make this program possible in the first place. In that sense, they are part of the solution this time, not the problem. But of course, it remains to be seen, Sarah, whether we see any kind of pushback and kickback in due course.
No, I mean, that's fascinating that you think it's going to be so large and have so much demand that it could all be allotted on day one. Kate, if you're still there, what are you hearing from small business as to willingness to go for loans? And if there is, so much demand, how do they prioritize who gets first?
So, Sarah, that's the thing that's definitely concerning a lot of small business owners on Main Street we're talking to, is that it will be first come, first served. So a lot of them are reaching out to their banks now in advance, getting their application paperwork ready and hoping that they'll be ready to go. But they are concerned about, this loan program running out of money quickly. In terms of taking on the loans, I think a lot of them are willing to do it. We've heard from one business owner, he thinks it's patriotic to take on a loan like this, even if he's not able to rehire everyone that he had when this all began. His loan forgiveness could be 90% versus 100%, and he feels it's the right thing to do. So that's a lot of what we've been hearing.
Kate, thanks so much for that. No doubt many more ups and downs on this story before Friday. Now, after the break, Morgan Stanley Chairman and CEO James Gorman will join us live. His take on these crazy markets and how the banking industry is holding up. And as we head to break, here's a check on bonds. Treasury yields taking a big leg lower today, particularly the long end. The 10-year currently yielding around 0.61%. Our special coverage is right back after this short break with James Gorman. Don't want to miss that.
Unusual situation so what we are noticing
Download
is
TuneIn
that
from the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know. It's TuneIn Sports on this day. April 1st, 1991, Duke beats Kansas to win their first men's basketball title. Power forward Christian Laettner was named the most outstanding player.
Sees Davis with Berry intercepts. Final seconds. Jordan without the jumper. It doesn't matter. Duke has won its first national championship.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. 20 seconds.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building.
For these and more, search sports and scroll down to the world of wrestling.
settlements.
Hi, I'm Maggie from Peachtree. We've been helping people for over 20 years. We can help you turn your settlement or annuity payments into the cash you need for a new car, housing, or to manage debt. Recently, I helped a customer get money for fertility treatments to start a family. It's your money, and you have the right to use it now.
Get your money faster by calling Peachtree now at 866-320-8074. Call today for a free quote. You may even qualify for a cash advance. That's 866-320-8074 or visit PeachtreeFinancial.com.
Welcome back. 30 minutes left of trade. It is a sea of red out there on this first day of April. With this S&P down more than 4%. There's a look at your sector heat map. Everybody's lower at the moment, but the sharpest declines are really coming for the utilities and the real estate stocks. Each of those are down more than 7%, though banks are not far behind. The financials down 6.3%. Consumer staples holding up the best, down only 2%. Materials right behind them. With 30 minutes left of trade, Wilfred, coming off the worst first quarter for the Dow in history.
Yes, indeed, Sarah. As you said, stocks down sharply, having had their worst quarter for decades, and banks have been one of the sectors that have been front and center during the sell-off, including today. Morgan Stanley Chairman and CEO James Gorman joins us now by phone in a CNBC exclusive. James, a very good afternoon to you. Thanks for joining us.
Sure, Wilfred. Thanks for having us.
I wanted to start, if I may, by the pledge you made recently that was no layoffs whatsoever at Morgan Stanley for all of 2020. Talk us through your thinking behind that and the response you got internally.
Well, firstly, if you just step back a little bit and think of how many folks are suffering through this process and through this crisis. And I was out walking late last night around the streets and just watching the ambulances go by. I went by one of our local hospitals. I mean, these people are heroes, what they're doing, and the way they're treating people and being so responsive. So for corporations like ours that, frankly, are in good financial shape, it's an easy lift to support our employees in a time of stress like this. It's the least we can do, and I know a lot of other companies have done it. We're not unique at all, but we're a large company. We could absorb it, and we thought it was the right thing to do.
And did you get positive responses internally, or were people kind of, I guess, expecting it at all?
No, I think, listen, everybody's got so much to worry about. They're worried about their families. They're worried about their health. This was one worry we just wanted to take off the table for this year. And, yeah, of course, folks appreciate it. And our teams are doing a lot in their communities and a lot of other philanthropic stuff. But, it's what large companies should be doing. So I don't feel it was a particularly special moment. It was just something to help take one piece of anxiety off our employees and their families' shoulders.
And James, where are all of those employees at the moment? What percentage of the workforce is working at home? And have you been surprised by how the company's been able to continue its operations almost as normal, I guess, despite a lot working from home?
Yeah, it's extraordinary. We've got over 90% of our employees and contractors working from home, over 70,000 folks. That's all over the world, by the way, 90%. And the place is functioning. I mean, we had, for a period there, we had our 10 busiest days in history in terms of just volumes. Processed all of that well. We have BCP centers in London, Tokyo, Hong Kong, and of course New York, and that all functioned well. And Wilfred, and you and I spoke about this a while back. If this had been during the financial crisis, which I also lived through 12 years ago, the industry would not have been capable of handling this kind of response. We just didn't have the infrastructure set up, and I don't think Morgan Stanley is unique. I can't speak for the others, but I know based on my calls with the other CEOs, everybody's managed through this extraordinarily well.
Well, it's good to hear that, James. And clearly volatility's back today, and it's been ferocious all year pretty much, but was particularly ferocious a couple of weeks ago. During those moments, I mean, gauge for us how bad was it? Were you worried about the outlook for the industry at all a couple of those trading days?
Well, listen, if you go back a couple of weeks, we obviously had the massive uncertainty around the health crisis, which we're getting more and more data on. It still remains very scary for a lot of people, but at least we have some understanding what the arc looks like, and there's some positive news coming out of particularly Korea and, you know, what Hong Kong did and Singapore did. So there are examples where that works, but we had that going on with funding issues, massive liquidity issues, emerging credit issues, unemployment issues, and of course, equity market volatility. So it's not surprising that 2 weeks ago was kind of the apex of collective anxiety. And, you know, was I concerned? No, we're probably the largest, we are the largest equity volume transactor in the world. We have the largest equities business in the world. Our pipes were working, so I was confident the industry's pipes were working. But there were clearly liquidity challenges, which, you know, and I'm sure we'll talk about the actions of the Fed and Treasury to deal with that, which they've done brilliantly.
Well, let's talk about that. I mean, how impressed have you been by their response, and what areas still need to be addressed? We've seen commercial paper and credit tick up again a little bit today. So talk us through the response and what you still need to see.
Yeah, well, you know, just start with the human side. I mean, the most important initiatives separate the markets for the minute and just talk about unemployment and folks who are struggling. What Treasury did with the small business paycheck protection program, I think it's just brilliant. You take out a loan as a small business owner, you hire your people back, and the loan gets forgiven. And, you know, the infrastructure being set up with the banks and the lenders to process that. You combine that with the enhanced unemployment insurance. You combine that with what Freddie and Fannie are doing on the mortgage side. Potential, phase 4, further initiatives coming out of the government. I mean, it's been a bazooka of bazookas, and that has to give people some comfort. For the markets, what the Fed has done, and the way they've supported the CP market, they've supported the munis market. Obviously, they've figured out a whole range of things which we learned from in the crisis, but the difference is the implementation has been dramatically accelerated here from sort of months down to days. And I think the Fed and the Fed markets folks in New York City, I'm on the New York Fed board, have done a brilliant job in navigating this, and that's why you're seeing liquidity come back. But, it remains choppy, and it's going to remain choppy for a while.
James, it's Sarah. Thanks for joining the show. Good to talk to you.
Sure, Sarah.
You just used the word apex when you were talking about the markets and sort of that period at the height of fear and some nervous sentiment. Does that mean you think we've seen the worst of it here?
Personally, I think we've seen the worst of the market funding liquidity issues. We've seen how the banks and market participants and the exchanges have operated. So we've seen a pretty good window into how the operations have held up globally. We're, now all operating with 90% of our employees roughly from home. Probably all the banks are 80+%. So that's functioning. Equity markets, I mean, our house call is that we're banging around on, but honestly, the next 6 months still remain extremely uncertain. And despite the fiscal actions, you could see a lot of volatility, and we'll see in the equity market. So, if I look at the aggregate of sort of market-related activities, I do think a couple of weeks ago felt to me like as bad as we were going to get without dramatically different economic or human tragedy taking place in the next several months.
So many of the Wall Street firms are saying we're already in recession. We've heard that. Even Jay Powell on the Today Show said that. And the forecasts are pretty bleak for at least the second quarter, down 20%, 35% for GDP. Is that something that you can see for this economy? And what would that mean for the banks?
Well, if you're having 3 million unemployment claims spike in a week, you're clearly in a recession. Whatever the technical moment of inflection point, we're going to have a global recession. I felt this a month ago, and that's clear. The issue is not do we have a recession. We are having a recession. The issue is how well do we rebound? Is it a V? Is it a U? Is it a long L? The bazooka efforts by the governments and the combined central banks would suggest that once the medical emergency passes and more people people who have either been infected can go back to work, or the social distancing has worked where more and more people can be employed, I think the shorter the recessionary period. But we're going to have one. Whether the markets, whether the economy is down 20, 25, 30%, I mean, everybody's got an opinion on that for the next quarter. I'm less focused on. I'm more focused about long-term stability.
James, back to some Morgan Stanley specific questions, if we can. What are you thinking about the E-Trade acquisition? Do you think that was particularly well timed when your stock price was higher, or badly timed relative, of course, to the environment that we're in now that you couldn't have predicted?
Well, I don't think it's fair to judge, and speak about valuation and so on. I think it was fairly valued. It was an all-stock deal, as you know. So, as both stocks have moved and would have moved post-crisis, I'm very comfortable with having done an all-stock deal. I'll just say that. As for the business, more importantly, the E-Trade folks, I think, have handled this brilliantly. They've had very little disruption to their platform, and this is exactly the kind of reasons why we want to buy this business. This gives us world-class technology capability, and particularly as people now have learned to deal much more remotely, it will augment what we're doing with our financial advisors. So I think that's terrific, and it just provides more balance to our business model. It's more wealth management revenues, it's more stability, it's less volatile than the core markets businesses. So, net, I'm happier now that we did the deal when we did it. Would have been impossible to do it right now. The team over there is terrific. And, from the price perspective, it was a stock-for-stock deal, so it was pretty straightforward.
James, you're, of course, the current chair of the Financial Services Forum, and that was the medium that the suspension of buybacks for the big 8 banks was announced. So you were clearly front and center when that decision was unfolding. Where do you stand on dividend payments? Clearly, across Europe and the UK, that became very topical, and they all led to suspending their dividends. Will you and your peers keep your dividends, do you think?
Well, yes, we will. And let me just start with the buyback. This was a voluntary decision. It was pretty historic. The big banks got together and said, listen, we've got plenty of capital, but we want to preserve that capital to support our clients and our corporates and use our balance sheets to support them. And they came together as a group. And I thought that, I was really proud of the way that happened. And I know, the regulatory environment appreciated that. And it was a smart and wise thing to do. Dividends are a different matter. The banks have given up 70% of their capital distribution by foregoing buybacks. Remember, the recipient of the dividends are many times small individuals who own these very large bank stocks all over the country. To lose that income at this time, I happen to think would be a very poor thing to do. And, this is not about us as institutions. It's not going to materially change in terms of your capital picture by foregoing, but I truly think it's destabilizing for investors, and it's dealing another punch in the head to the individual investor who, frankly, needs some of that dividend income coming in, whether it's from the banks or some of the other companies. Now, if we were capital short, that'd be completely different, but we're not. And I'm not going to comment on other regions of the world. I just focus on, the U.S. financial system for now.
James, I know we've got to let you go. Just a final kind of big picture question from me to finish things off on the banks. I mean, as we're talking, Morgan Stanley's down 8%, in line with all of the other banks. Your stock is down 40% year to date, and it was down more, of course, at the troughs of the market, which clearly paints a picture of at least a probability of Armageddon, even if that is the wrong picture it's painting. How should people think about what the banks are facing? Is it just an earnings hit for the year ahead, or is book value really under question to the extent that the share price has fallen, whether book value could halve as write-downs start to come out?
Yeah, listen, Wilfred, it's a fair question, and for better or for worse, as I said, I was co-president here during the financial crisis, and took over the reins in early 2010. So I've kind of seen it all in the last 12 years. Our stock was $6.71. In 2012, I think it was $11. So when I'm looking at your screen now, $31.30. It feels actually pretty good for what we're dealing with. The market's scared. When the market's scared and volatile, you're going to, in the more volatile sectors like ours, like the energy sector, transportation, you're going to take these hits. But, 12 months ago, our stock was $40. 3 months ago, it was $58. Today, it's $31. And I'm going to say something that's probably going to surprise you. I really don't look at the stock at all now. I don't care. It's just not a meaningful driver of how our company is performing, what our book value is, what the quality of our operations are, and what we're doing to serve our clients. The stock will look after itself. That's the last of my issues.
Well, James, as always, we thank you so much for your time and your insight. Much appreciated.
Sure. Thanks, guys. Thanks, Sarah. Thanks, Wilfred.
James Gorman, the chairman and CEO of Morgan Stanley, joining us there. The stock down sharply, but, trying to look past that. And, Sarah, as you picked up on there, crucially in the middle, suggesting that the apex in terms of peak of fear for the markets is behind us unless we see a wild card pickup in terms of the fundamental health issues from where the base case is at the moment.
Yeah, really encouraging comments and praise for the Federal Reserve and the fiscal authorities. I think he called the small business loans a brilliant move. As we were speaking to Mr. Gorman, just want to point out the market for you. We've got 15 minutes left of trade, and we are racing to new session lows here. The Dow is now down more than 1,000 points, 1,015 points, down 4.7%. Remember, this comes after a pretty strong rally for the markets to end the quarter and the week, but also a pretty dismal quarter overall for stocks. President Trump last night warning of a very, very painful period here for the next few weeks for America. That's clearly impacting sentiment. This is the last commercial break we're going to take before we take you into the close. Up next, uninterrupted coverage of the final minutes of trade when we go inside the market zone. The Dow again down 1,026 points.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know. It's TuneIn Sports on this day, March 27th, 1988. The Chicago Bulls and Atlanta Hawks match up in the Georgia Dome in Atlanta. Now, it draws a crowd of 62,046, the largest in any game in the NBA history. And the Bulls win 89-74.
But there's no question the spotlight today will focus on Dominique. Given what happened last week, I would think there's some incentive for Dominique
to listen to conversations breaking down the moments just like this. Click on Sports to be part of the discussion on TuneIn.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wait a second.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building. But
For these and more, search sports and scroll down to the world of wrestling.
At Southern New Hampshire University, we're committed to making college more affordable. That's why we're keeping our tuition the same through the year 2021.
I knew SNHU was the place for me when I saw how affordable it was.
Find your degree at snhu.edu.
You should be mad at leaf blowers. You should be mad your neighbor always wants to hang out. And you should be mad your smart fridge is unnecessarily complicated. Making ice. But you're not mad because you have E-Trade, which isn't complicated. Their tools make trading quicker and simpler so you can take on the markets with confidence. Don't get mad. Get E-Trade and start trading commission-free today.
The Market Zone is sponsored by E-Trade. Get $100 on us when you deposit $5,000.
Welcome back. 11 minutes left in the trading day. We're now in the closing bell market zone. Commercial-free coverage of all of the action going on into the close. CNBC senior markets commentator Mike Santoli is here to break down these crucial moments of the trading day. And today we've got Ritholtz Wealth Management CEO Josh Brown with us as well.
Let's kick things off with the broader market. DoubleLine Capital's Jeffrey Gundlach says he believes the worst is yet to come, saying, quote, "The low we hit in the middle of March, I would bet that low will get taken out. The market has really made it back to a resistance zone, and the market continues to act somewhat dysfunctionally, in my opinion. Take out the low of March, and then we'll get a more enduring low." It's a bearish take, Josh Brown, but it's not that hard to see why you would make that kind of call, given the headlines out there and the number of cases out there, and still the work that needs to be done on testing and all these other big unknowns that investors have been grappling with.
Yeah, no, I think he could certainly be right. And one of the things that I've been saying recently, I think on this show last week, it's really hard to make a credible case to look back at the low that we printed and said, yeah, that's it. That's as bad as it's going to get, while the death rate continues to go up. I understand it's not accelerating at the same rate, but we're talking about every night thousands of new deaths just in my city. So, how can you look at the past market low and say, yeah, that's probably the end of it? So I really do feel that what your prior guest, James Gorman, the CEO of Morgan Stanley, said is actually more important than, is it 18,000? Is it 16,000? He's talking about the duration versus the depth. It makes no difference at this point if we're going to be down 30% in GDP or 27%. That is irrelevant. It's the length of time before we can get back to normal that I think is the primary reason for why the market's selling off today. Look at what's going down. Mortgage REITs, right? Banks are way worse than the overall market by double. Why? Because the duration, and that is a direct extension of what we heard last night, that the next 2 weeks are going to be terrible and that this could be extended through the end of April. 2 weeks ago, we were thinking mid-April. So as that duration gets pushed back, the market gets worse, and the exact parts of the market that you would expect to get worse, small caps are horrendous today. That's what you're seeing playing out. And I'm not going to change my opinion until I feel like we've gotten the health side of this. The stimulus is great. It's the health side that's really the issue.
And Mike, to Josh's point in bringing up James Gorman's comments there, they weren't the exact polar opposite to Gundlach's comments, because Gorman was not addressing the level of the market, but he was addressing the functionality of markets at the moment and suggesting that the peak of the poor functioning of markets has passed us. How are we functioning today amidst another big sell-off down 5% or so? Are we functioning better than we were last time we had these sorts of moves to the downside?
I do think functioning better. And by the way, we're not having the same types of moves because we were going down 9 and 10%. And it was much more jumpy and a lot more air pockets. But I think that's a low bar to say that, we're able to transact somewhere near the market. I mean, I am looking at things like, muni bonds are trading poorly today and other credit products that are not really well bid. I think there's just a general illiquidity out there. People are kind of keeping capital close. So I think he's probably correct that in terms of the absolute functioning of the market, the plumbing story, that has probably been addressed to a large degree. But the market is impatient. I mean, I think a rational person, to what Josh is saying, says, we just have to wait and see. We have to wait until the data build up. We have to wait until we see what these trends are, what we can kind of handicap based on a critical mass of information. The market itself doesn't wait and see. It trades every day. And if there's no buyers at a price, it's going to go lower to find the buyer at that price. And that's really all that's going on. And, in one way, it's a very unique situation. In another, what Gundlach says is purely textbook, which is you get the minimally acceptable bounce off of a panic low, which is what we got, 15 to 20%. And then you backslide and see if you find some footing after that point. So I don't think anything's ordained at this point. We just have to kind of see how it plays and be open-minded about exactly what the tactics are going to be.
Mike and Wilfred, do you want to see how the market's functioning? Look at treasuries. So treasuries are in demand today. They're buying safe haven. debt, and that's pushing yields lower. And that is what you expect to see when you see a 1,000-point sell-off in the Dow. So while it shows that there's still a lot of fear and nervousness out there about the outlook and about the news, it's actually a good thing for functioning, because one of the funky things that was happening over the last few weeks is that Treasury yields were higher on days where stocks sold off very sharply like today. And that was a sign that things weren't functioning so well.
Well, that was also a sign that people were having to just sell everything they had and get carried out afterwards.
True.
So that activity seems like it's worked its way through.
I totally agree. The other thing, of course, on that point is the dollar is higher today, albeit it's doing so in a slightly more reserved fashion than we had over prior weeks. Anyway, let's move on and dive directly into the banks. KBW making calls on two of the big banks today. The firm upgrading JP Morgan to outperform from market perform, saying the bank is well positioned to withstand a recession and come out of it in a better position than most banks. The firm also downgrading Citi to market perform from outperform, citing Citi's elevated risks outside the US and less certainty on the damage coronavirus could have on the bank's revenue growth. Citigroup CEO Mike Corbat appeared on CNBC earlier and assured investors that unlike European rivals, the bank has no plans to alter its dividend.
There's some structural and nuances, Jim, between the U.S. and Europe that are a bit different. One is that the European banks pay an annual dividend, and so there's a window in which to declare. We pay quarterly dividends. If you look at the capital levels, if you look at the earnings of the U.S. banks, I think they come into this in a bit of a different, from a different position, a position probably of some more strength. So, from our perspective, our dividend is sound, and we plan on continuing to pay it.
Stanley Chairman and CEO James Gorman just joined us and echoed a similar sentiment.
The recipient of the dividends are many times small individuals who own these very large bank stocks all over the country. To lose that income at this time, I happen to think would be a very poor thing to do. And, this is not about us as institutions. It's not going to materially change in terms of your capital picture by foregoing, but I truly think it's destabilizing for investors, and it's dealing another punch in the head to the individual investor who, frankly, needs some of that dividend income coming in.
Of course, the other key difference versus Europe is that the banks here have already cancelled over 75% of their total capital return programs by cancelling buybacks, whereas in Europe, the vast majority of returns is tilted towards dividends, and so they cancelled the dividends instead. Mike, to come to this point, though, a lot of those banks, therefore, it seems like they'll all keep their dividends. I doubt you'll get one doing it and not the others, because they would paint a picture that they needed to if the others didn't need to. But looking at the dividend yields, I mean, Wells Fargo's on 7.5%, most of them above 4%, a couple of them around 5%. But are people buying stocks yet because of valuation indicators like a dividend yield, or are we still not at that point?
I think not while we're in an environment where the stock price itself can go down 6% in a day, as many of them are today, and you've basically lost your annual dividend yield. So I don't think that's purely what's going on. I do think on a relative basis, it's gonna make them look more attractive than they otherwise would. And I think it's fair to accept all these companies saying that they fully can cover these dividends and they are committed to them, and that's their intent. But it doesn't mean the business gets a lot better. I mean, when we say they're well capitalized, banks as a whole, it's true, but that just means it's more capital they can burn through before they really get to a critical point. And if we're going in a rough credit cycle, that's what's going to happen. So I do think that at some point there's yield support, but not when the market is this jumpy.
3 minutes left of trade, guys. We got to hit auto sales because we got new data on that front all day today showing the impact of the coronavirus and it's having on the consumer and autos in particular. Phil LeBeau with the details. Phil.
Sarah, the numbers for the first quarter for the automakers, not pretty. Nobody expected them to be good. Remember, January and February were up, but then you have Fiat, Chrysler, Toyota, and GM all reporting declines of between 7 and 10%. The decline all because of what happened in March. Need some specific snapshots of how bad it was in March for the automakers. Take a look at Toyota, down 36%, actually 36.9% in the month of March for U.S. auto sales. Hyundai, even worse, down 43%. If there is any good news at all, a sliver of good news for GM, Ford, and Fiat Chrysler, it's that their 0% offers probably brought in a few people, muted the declines that they saw in the month, but guys, still not pretty across the board for the automakers.
Phil, thank you. Phil LeBeau. 2 minutes left of trade. Mike has more on the market internals today. Mike, what are you seeing?
It's pretty lopsided to the downside, as you would expect, Sarah. Kind of a washout on New York Stock Exchange, up versus down volume, more than 90% to the downside. That shows you it's another kind of liquidation day out there, even if it's at a slower pace. They want to look at a couple of retail names. Walmart, I mean, this is basically your flight to safety in this market, is stocks like Walmart. And you see it's well outperforming. TJX, former darling, down 30% off its highs because it's so reliant on in-store browsing. Then the VIX, it's popping, but basically just matching the actual realized volatility of the day, back up into the mid-50s, still well below last week's high, as is probably appropriate given that we did have that crescendo of panic then.
Mike, thanks for that. We have got 40 seconds left of the session, and we are down 4.5% on the S&P 500. Similar percentage decline for the Dow, which is close to 1,000 points lower. The low of the session was about 20 minutes ago, down 1,132. So we're fractionally off those lows, but nonetheless still a pretty ugly picture, as you can see. NASDAQ also down a similar amount, 4.4%. The Russell really suffering today. It's down 7% just today. Should mention, though, if the S&P is down 4.4% as we stand, it is down 2.8% only for the week. We did have a bit of positivity early in the week. As the bell goes, we are down 4.3% on the S&P 500. All sectors lower, led lower by real estate, utilities, and financials, down 5 or 6% each. And those three sectors also the worst so far this week. There is the close. The Dow down 973 points. Sarah.
Kicking off April and a new quarter in the red. Welcome back, everyone. If you're just joining us, I'm Sarah Eisen, here with Wilfred Frost, along with Mike Santoli, CNBC Senior Markets Commentator.
Let's check in on those closes for you. Down 4.44% on the Dow, 973 points lower. Fractionally off the session lows by about 150 points or so, but still an ugly day, down 4.4% for the S&P. Similar percentage terms for the NASDAQ, down 7% for the Russell. Coming up in just a bit, we'll speak with the CEO of Centene about the moves they're making to waive coronavirus-related costs. Joining us to talk about the market day, Ritholtz Wealth Management CEO Josh Brown and BNY Mellon's Liz Young. Mike, first to you. Comfortably today, wiping out the gains we'd seen so far this week, though we still have a bit to work with from last week as well in terms of bouncing off the bottom.
Yeah, I mean, obviously went up close to 20% off the low to last Thursday's high. Then we've basically been surrendering some of that gain ever since then. It doesn't seem as if there's much of a particular story behind it, except for the fact that everyone got extremely fixated on the quarter end and the pension fund rebalancing back into equities. We did get too focused on it, probably because there was nothing else really to pin any specific hopes on in terms of a catalyst for buyers. So here we are, first day of the quarter, and just backsliding a little bit. Not terribly unexpected to give some back, but I do think it's inherently kind of tenuous when we're talking about we only had 3 up days that were getting us away from the recent low. So it still seems like it's a little bit touchy, and the compression in Treasury yields, it also tells a story. The stock market doesn't do that well when those yields get toward their lows.
Josh Brown, as for the why, I mean, there's so many catalysts right now when it comes to the virus and the economy and the impact. We did get that pretty dire warning and a total change of tone from President Trump, I thought, last night, that as many as 240,000 Americans could die, according to White House officials' projections, of this horrific disease. At the same time, you do have good news in the Abbott Labs and the J&J and the continued innovation and ingenuity of the U.S. pharmaceutical sector and the U.S. healthcare system to come up with tests and antivirals and antibody tests and all the things that we need to try to get back to normal. How do you make sense of all of these headlines and how they dictate a market's direction on a given day?
Well, I'll just address the testing quickly. It's great that all of these tools are now leaving the labs and going out into the fields, but all the testing does is tell us that actually the spread is worse than we thought. And of course, we need that information. Healthcare providers need that information. Policymakers need that. But the market interprets that as, oh, this isn't a spring thing. This is a summer thing. And that's what you're seeing today. And I'm going to tell you something, and I don't think you guys touched on this yet. The leaders to the downside being mortgage REITs and utilities on a day where yields are down is extremely concerning. There are only 2 reasons why you would ever see a sell-off led by mortgage REITs and utilities. Number one, interest rates go up. Therefore, offering a more risk-free competition in terms of the yields that investors desire. That's not what's happening today. Number two is if there are serious widespread concerns about homeowners being able to pay their two most important bills, the mortgage and the power. So I don't like an environment where yields are being compressed and going lower, and at the same time, we're getting these big, nasty sell-offs in the quote-unquote safest parts of the stock market that ordinarily you would think people would be looking for to buy for those yields. And so when you have a market being led that way, then I'm more inclined to say people are now repricing in an even further economic disruption than what had been previously priced in.
Josh,
and most of what we saw last week was counter-trend.
Josh, I wanted to ask about the REITs in particular, because you have liked this sector and you've recommended it a number of times on Closing Bell, and it has been, relatively an outperformer on defensiveness and on yield plays. But in a world where, James Gorman just on to Morgan Stanley and so many other CEOs telling us a bulk of their employees are working from home and it's working out efficiently, the question is, how does that change the business model in the future? Maybe they can spare some expense, not paying those high commercial real estate costs down the line, and have more people working from home. I think people are trying to figure that out.
That's a really tough question for commercial real estate investors. I don't personally have exposure to office building REITs or any kind of paper related to the sector, but for sure, that's going to be a very highly trafficked area for distressed debt investors. What is the real price per square foot in Manhattan, Boston, Chicago a year from now? And we see how easily so many companies, small ones like mine with 31 employees and large ones like Mr. Gorman's with thousands of employees, how seamlessly so many of our day-to-day tasks were moved from an office building to a living room. Sarah, I think that is absolutely the right question. I don't think that's related to what we're seeing in mortgage bond REITs today, but yeah, that's a whole other area. And so there are two ways to look at that. Obviously, it's not great if you're an investor in that space, commercial real estate in general. However, if you're an equity investor and you're saying, well, what is the opportunity as a result of that? I know Zoom's been discussed on the network forever, and I'm an investor there. Slack, Microsoft, Amazon, any company that's got cloud computing as part of their business model, remote working software, that the drumbeat for that stuff is only to get louder. More people are going to want to learn about those companies, because I do think not only are they giving us a bridge between now and normalcy, but on the other side, we're going to realize how much more efficient it is to be communicating that way in so many different arenas.
Liz Young, Josh pointed there to some of the structural aspects in today's trade that worried him in terms of the sector performance. How did you take what we saw today, and does it concern you that we're going to retest the lows, or is this just to be expected, as Mike was kind of pointing to after we bounced 20% from the lows?
A lot of this was to be expected. Last week's rally was really due to monetary and fiscal support. And I don't think it was unusual to expect to see a little bit of a bounce after that. What I would say about that going forward is, as we get used to the fact that this is probably going to last longer than we thought, if we even get another fiscal package down the road, we probably won't see as much positivity as a result, because that means that it's lasting longer. So going forward, I think we are going to stay in this range for a while, and I don't think it's unreasonable to expect us to stay in this range. If you look at the forward PE on the S&P right now, 15.4 times is still quite a bit above where we usually get to in a crisis. We usually get somewhere between 10 and 13 times. So it's okay to expect that we have a little more downside here. And you also have to remember, March was a month where we really had no data to work on whatsoever. April is the beginning of a month where we have actual economic data to look at. We're going to have earnings data to digest. Markets hate uncertainty. We're still in a pretty uncertain time here. But as we move through April, we'll have a little bit more to model out, and we can get some clarity. Even in the worst case scenario, we can get more clarity about how to model this.
Let's take a closer look at the session today. 29 out of 30 Dow stocks falling. Walmart was the exception. Let's go to Bob Pisani now for a check on some of the movers and what happened today. Bob.
Sarah, Josh had the right tone on this. 6% decline, banks, utilities, and REITs. Just take a look here. REITs, we talked all day about how the mall and office REITs were to the downside. No bounce there. 6% decline, 7% decline in regional banks like Fifth Third and Regions Financial. So the bank index, the KBE, down about the same amount, 6%. Utilities, even the regulated utilities like American Electric, were down about 6%. What do they all have in common? Banks, utilities, REITs? They could all get stiffed if consumers and businesses don't pay their mortgages and their utility bills. I agree with Josh, and that's a very unusual situation. We were in a defensive crouch all day. So the Cloroxes of the world were up, the Krogers, the Walmart, the Costcos. Finally, the one level to watch, S&P 2237. That was the February 23rd low. We're well above that right now. Guys, back to you.
Bob Pisani, thanks so much for that. Let's get over to Rick Santelli for a check-in on the bond markets today. Hey, Rick.
Hey, Wilf. You know, maybe two-day charts will give us a great glimpse of what's been happening with treasuries today. Maybe yields moving down is happy times for some, but on days like today, really showcases how it makes many nervous. Look at a two-day of two-year, pretty much a flatter scenario. Once you go to the longer end, you can see the drift on the long end. And of course, 10s minus 2s definitely flattened rather dramatically today, trading around 36 right now. Let's look at the HYG since mid-February. It closed down over 2.5. That shows some nervousness. And if you look at the 5-year generic CDS credit default swaps, you'll see that they moved up a bit as well. So we see that there are credit issues going on in the market today. Even though yields move down, that's not always a good thing. Sarah, back to you.
Rick Santelli, thank you. Would add to that the stronger dollar, which has also been sort of a sign of stress lately. Liz Young, how do you take, as an equity strategist, some of these signs in the credit markets, the CDS that Rick was just talking about, the currency, and factor that into the action you're seeing in stocks?
We've lost Liz there. Sorry, go ahead.
I think
Sarah.
Liz Young's. I thought it was my shot, President. I'm so used to that being the case. Maybe Liz Young, are you back with us? Can you hear us?
So I think I'm here.
Okay, you're here. The gremlins are out again today. I was just asking to follow up on Rick's point. Rick mentioned a little bit of signs of stress and illiquidity. It was patchy in the credit markets today. He was showing some CDS widening, credit default swaps, the fact that the dollar was a little bit higher. I was just wondering how that factors into the overall equity trade and how closely the stock market investors are watching those sort of issues.
I think anybody who isn't watching them should be watching them. And credit is certainly one of the vulnerabilities that we've been watching since the beginning of this. And it was a scenario that we were pretty concerned with even before we had stress in the market, mostly because there's so much debt out there. And the proliferation of ETFs in the space, too, has made things trade much differently than they ever did before. And we've never had this many ETFs around during a crisis. So this is something that I think exposes the vulnerabilities, whether we knew about them or not, especially in times of stress. But the saving grace here is that the Fed came in, the Fed knew that there was vulnerability there. The Fed knew that they needed to do something to produce liquidity in the market, and they really threw everything in the kitchen at it. So I think at this point, we're at a pretty good level where the Fed will protect liquidity in the market, and the market is functioning certainly better than it was 2 weeks ago. We're going to continue to see stress, especially on down days like this. I don't think that's unusual, but it's certainly a place that investors should be watching if you're an equity investor and you're thinking about putting some more risk on the table.
Josh Brown, clearly you echoed a little bit more of a cautious tone at the top of the hour in this segment. If we stay with a timeline where this is a summer issue as opposed to a spring issue, which is, I think, as you referred to it, what level of fall in the S&P 500 again from here would make you think that we get to the level where this is a buying opportunity again as opposed to something to be cautious of?
You know, it's a really good question, and I think about it all the time. But as a rules-based investor, we really don't make those guesses. We have a tactical model that is usually a portion of clients' accounts, and it reacts to the trend of the market. So my gut instincts or my opinions on COVID-19 treatments, none of that stuff makes it in, thank God, because I'm really not good at that. The one thing I would tell you, though, is there has been absolutely no change in trend when you pull the lens back So you could look at last week and you could say, wow, this is really great. Look at the recoveries. And I was all for looking at that and saying, wow, we got a chance to catch our breath. But there is no change to the fact that we're in a bear market. And I'll remind you, and I know I've said this before, the history of bear markets tells us that 20% rallies are not out of the question, and they don't signify the end. They signify the fact that things just got too bad too fast. That's what we had last week. Be prepared. It can happen again. We can get another 20% rally. That means absolutely nothing next week or the week after.
Josh Brown, Liz Young, great to see you both. Thanks for joining us.
Thank you.
Up next, BlackRock's Ross Kosterich will join us and discuss why the equity and credit markets may be starting to form a bottom and where he sees the biggest buying opportunities right now. We're back in 90 seconds.
Are you curious what others are listening to on TuneIn? Head to the trending section under Browse to see the most popular stations and podcasts among TuneIn listeners right now. Check it out. You might just discover something new for yourself.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving, soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wait a second.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building. But
For these and more, search sports and scroll down to the world of wrestling.
It's TuneIn Sports on this day. April 1st, 1991, Duke beats Kansas to win their first men's basketball title. Power forward Christian Laettner was named the most outstanding player.
Sees Davis with Barry.
Welcome back. Some breaking news now on AMC. Julia Borston with the details. Julia.
That's right. Theater chain AMC's lenders are hiring lawyers for restructuring talks. That's according to a Dow Jones report. Now, AMC's junior bonds are trading at 40 cents on the dollar, and AMC faces default risk after closing more than 1,000 theaters, both here in the U.S. and around the world. Now, AMC shares did close the day down about 17%. Cinemark, the other major publicly traded movie theater chain, its shares closed the day down about 21%. So you see those theater chains trading down dramatically despite being included in the bailout. Back over to you.
Julia, thanks so much for that. Certainly a tough sector to be in at the moment. Let's have a look at the markets. A reminder of how we closed, down about 4.4%, close to 1,000 points on the Dow, just off the session lows, which was down about 1,100 points on the Dow. Joining us now via phone, Ross Kosterich, portfolio manager at BlackRock Global Allocation Fund. Ross, great to have you with us. Wanted to kick things off in terms of just those technical aspects that we're seeing in the market as you look across all of those different asset classes. We spoke earlier with James Gorman how bad it was a couple of weeks ago, that it may have peaked then. But today, a few hints of that coming back when you see the dollar strengthening again and a little bit of a pickup in credit spreads. But overall, are you still happy that the technicals are much better than they were a couple of weeks ago?
Well, happy is a strong word, but I do agree. I think the technicals are better, and there are a few reasons for that. One of which is, look, it's not clear that we've hit the absolute bottom, but we are seeing some pullback in volatility. It looks like some of the forced selling that characterized the market a few weeks ago, where you saw risk parity funds, levered funds, equity long short, all sorts of different players just dramatically reducing leverage. It looks like we've worked through a lot of that. And your point about credit, we did see a little widening of spreads, but we are definitely in a much better place than we were a couple of weeks ago, when it wasn't just the credit markets, it was the money markets, even the treasury market looked dislocated. I don't think you're seeing that same type of liquidation today. This, to me, is the normal process of backing and filling as you form a bottom.
So, Russ, how do you make a call from here on the stock market without knowing how many cases there are in the U.S., how many deaths there will be in the U.S., how long we're going to be working from home and sheltering in place, how long it's going to take to get tests out onto a broader scale. I mean, these are questions that even the doctors don't really have answers to because we've never experienced anything like this. So how do you take those sort of big questions which have been driving the uncertainty on the economy and the markets and formulate a view on stocks?
Well, I think the short answer to your question is you do it very humbly because of all the reasons you just cited. We don't know the path of the virus. We don't know when the lockdown is going to end. We don't know the path to recovery because we've just never seen anything like this in modern times. So you have to acknowledge the uncertainty. I think what you do is you look for a couple of things. One, rules of thumb. We're likely to see the credit markets bottom before the equity markets. So I think you're totally right, to begin this discussion, what's happening in credit markets, that's a key variable. The second, obviously, is going to be to get whatever indication we can, both out of Europe and the U.S., which are now the epicenter of this crisis, of how the virus is progressing. We're starting to see some deceleration. And then finally, I think the other thing to look for are valuations. Stocks are a lot cheaper than they were. You can debate if they're actually cheap depending upon the metric you use. But the reality is, can you on a bottom-up basis find good companies that even on your worst-case scenario appear to be trading in a bargain? And that's when I think you'll start to see more sustained money coming back into the market.
What about on the flip side, Russ? Are there protection-type assets that are still worth buying even though they've appreciated in value?
Wilford, I think that's key. I mean, we're basically doing a couple things in the portfolio. One, on the equity side, I think one of the things you can do for protection is you can emphasize qualities of style. What does that mean? Fortress-like balance sheets, companies that can get through this, earnings consistency. Outside of equities, I think the hedges are really the ones you typically look to, and quite honestly, they've worked. Not every day. We've had days when gold has not behaved, when treasuries have not behaved. But if you look at what rose in the first quarter, it was exactly what you'd expect to rise. It was treasuries, it was bonds, it was the dollar, it was yen, it was gold. I still think in an environment where your big risk is this huge economic uncertainty, those hedges still have a place in the portfolio. They're likely to continue to work.
You said to find good companies that will survive with good balance sheets. I know you can't necessarily name names, but give us a sense of what types of companies, what types of sectors investors should be looking to for that right now.
Absolutely. So, the truth is they're mostly the places we were emphasizing before, because I think a lot of these are going to see not obviously a benefit from this, but perhaps some of the changes we're going to see both on an economic basis, a societal basis, are still going to favor sectors like technology, software, healthcare, particularly services and pharma. We still think there are some models on the consumer side when you're talking about media, entertainment, that are going to continue to work. Obviously, everything is going to be correlated when we don't know how fast the economy is going down. But a lot of the sectors and industries that I discussed, these are places we see high quality, we see very high profitability, and we're confident they're going to make it through this environment. What I'd be cautious on doing is what typically works at the bottom of a bear market. Normally, you load up on value, you load up on cyclicals, and that's because often you get that V-shaped recovery with pent-up demand. As you pointed out, we don't know how this recovery is going to play out. I'd be much more cautious about that type of a strategy.
Yeah, our friend Kenny Placari, a trader, weighing in on that on Twitter, saying this is about active versus passive management when it comes to choosing companies and not just choosing the index. Do you see this, Russ, as a defining point, a turning point in the sort of decades-long debate?
Well, look, we still think there are a number of reasons why we've seen the move towards exchange-traded funds and other index products, and that's likely to continue. But I do think this is a stock picker's market, because even when you cite the industry, the segment of the market you'd like to be in, the reality is there are going to be winners and losers. And you think about the consumer space. There are business models that are going to benefit from this, and there are also businesses that are probably going to be put out permanently. Mm-hmm. And you do have to distinguish between those.
Russ Kostrich, thanks for joining us from BlackRock.
Thanks again.
Speaking of the consumer, we've got some retail earnings to tell you about. PVH is out. Courtney Reagan with the numbers. Courtney.
Hi, Sarah. So PVH beating on the top and bottom line, turning in adjusted earnings of $1.88 per share. Analysts were looking for $1.81. Revenues of $2.6 billion compared to $2.5 billion. The company is not providing forward guidance for either the first quarter or the full year because of what's going on with the coronavirus. They are also suspending both their dividend and their buyback program. They have used the revolver, tapping into $750 million of $1 billion available. The CEO is pointing to their history of a solid balance sheet, but also says, look, we're taking a hard look at discretionary spending, inventory, payroll, CapEx, sort of you name it. They're looking at all of it. And we know Manny Chirico, the CEO, will be on Mad Money this evening. So PVH reporting earnings beating, but no guidance given. Shares are higher by 6.7%. And we should note this was quarter ended February 2nd. So a lot has happened since then. Back over to you.
Thanks so much for that, Cord. I'll pick it up. PVH up 6.7%. Still ahead, the CEO of health insurer Centene will discuss whether he expects an influx of new Obamacare members as more people lose their employer-sponsored insurance because of coronavirus layoffs.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
A lot of people aren't aware that TuneIn lets you listen to the same terrestrial stations that you pick up on your FM AM dial, except you can hear them from anywhere. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
It's TuneIn Sports on this day, March 27th, 1988. The Chicago Bulls and Atlanta Hawks match up in the Georgia Dome in Atlanta. Now, it draws a crowd of 62,046, the largest in any game in the NBA history. And the Bulls win 89-74.
Well, there's no question the spotlight today will focus on Dominique. Given what happened last week, I would think there's some incentive for Dominique
to listen to conversations breaking down the moments just like this. Click on Sports to be part of the discussion on TuneIn. Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wait a second.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building. But
For these and more, search sports and scroll down to the world of wrestling.
Super easy. Start banking with Chime today at Chime.com.
Hi, I'm Hanno. I created Gabi because most people overpay on car insurance. Gabi is a free tool that saves you money by finding the best deal. Gabi users save more than $800 per year on average. Go to Gabi.com and stop overpaying for car insurance.
At Credible.com, we've helped tens of thousands of people save money by refinancing their student loans. In 3 minutes, we'll get you actual rates from multiple lenders. We could save you hundreds of dollars a month.
Visit Credible.com to see how much you could save.
He never really liked his food. He wouldn't eat till like 10 o'clock at night. You know, the typical giant bag, dried little balls. That kind of led me to Farmer's Dog. Now he knows when I open the refrigerator, it's coming. It's already portioned out. He's eating whole foods. It's amazing.
Visit betterforthem.com.
Have you heard?
What's up?
For the first time ever, you can watch the brand new Trolls World Tour movie at home.
What?
Ooh.
What a troll.
Trolls World Tour, rated PG, in theaters and at home on demand, April 10th.
Welcome back. Drug makers aren't the only companies trying to find a vaccine for the coronavirus. Frank Holland has the details for us. Hi, Frank.
Hey there, Wolf. British American Tobacco announcing today it's developing a COVID-19 vaccine using tobacco leaves at a subsidiary of the company in Kentucky, the maker of Lucky Strike cigarettes, sharing these images of the plants being cultivated with the goal of making a vaccine available by June and producing 1 to 3 million doses of that vaccine per week. However, the company has not started human testing just yet, making it a real challenge to get this potential vaccine ready on that timeline. Here's how it works. The company cloned a portion of COVID-19's genetic sequence, inserted that into tobacco plants, and developed a potential antigen. That's a substance that induces an immune response in the body. The company says this vaccine has the potential to work in a single dose. Potential really is the key word here. British American Tobacco says it's engaged with the FDA on this, but the FDA is not commenting on the matter.
That is a surprising development that the maker of cigarettes is working on a life-saving vaccine here. Frank Holland, thank you. Centene announcing it is waiving costs for coronavirus treatments for Medicare, Medicaid, and Marketplace members. The company will also cover telehealth services related to COVID-19. For more on this, we are joined by Centene CEO Michael Neidorff in an exclusive interview. So Michael, outline what you are doing for your clients and those that use your health care and how much it's going to cost.
Yes, well, let me comment that probably 2-3 weeks ago at the White House, and I thought most of that had already been agreed to. So we agreed that we're going to waive co-payments for anything associated with COVID-19, and that's across our population. And the intent there is, one, it takes the pressure off anybody thinking they have payments to make, and we deal with a very vulnerable population with Medicaid and low end on the Marketplace, etc. But it also, the part of the motivation why we did it is it also protects the providers, because the co-payment, if it's not paid, then they take the hit. This way, we'll be covering it. So that was the motivation of it, and it's really going to be covering across our market those co-payments associated with this. So there's no need for them to be concerned about service or how the provider is going to be compensated.
I wanted to ask you specifically about... Oh, go ahead. Sorry, Michael. Finish your thought.
I just going to answer the second half of your question. That the cost when you're our side, $106 billion this year in revenue. And the cost, whether it be $30, $40, $50 million, whatever it is, that's not the issue. The issue here is that we deal with this effectively and quickly and ensure that the population gets the care that they need. And there's a lot of talk about what's going to be services that they won't receive because they don't have access to other doctors for other services. I've commented for some time now, earnings this year are going to be lumpy. And there'll be pent-up demand, things of that nature. So we're not looking so much at the cost. We have an estimates. We are, of course, you have to do that to be responsible. But we think our shareholders will be in pretty good shape, all things considered.
Wanted to ask you about your Medicaid services, because I know that's a big part of your business. New York State released some data showing that the COVID pandemic is disproportionately affecting New York City's poorest neighborhoods and ravaging its poorest residents. So what are you expecting there, and what are you actually seeing in terms of people who have Medicaid?
Well, we expect a higher incidence of it. These individuals tend to live closer together, don't have as much room as they want to spread out when they're quarantining themselves in the house. But it's all within our estimates. We have not seen a lot of claims data yet to know what's there. But we expect a higher incidence and are planning for it in the urban area. Some of our nurses who are not as tied up in the office are now volunteering to help within the hospital settings and clinic settings to help this population.
Michael, are you seeing yet or are you expecting a big pickup in Medicaid enrollment based on the spike we've seen in unemployment claims?
We see a considerable spike in enrollment in Medicaid. We have a team working with the states to determine how they do that, because it's important that the enrollment be there and they be able to enroll and get the services. We work with the states to eliminate redeterminations and things to streamline it so it can happen quickly. We have been working on the elasticity of our services, whether it be phone services or the pre-authorization issues we've talked about. Those are things that we're really not doing a lot on when it comes to Corbett. So we see a big spike, but we're planning for it. And it should start to develop over the next, I would say, 30 to 90 days.
I saw Senator Bernie Sanders on The View today was talking about this, the fact that we need a single-payer system because of this crisis. How do you think this pandemic is going to change the U.S. healthcare system if at all, when this is all over?
Well, I don't think that it's going to change the attitudes of the general population in total on a single payer. I think we're going to have to be prepared for this type of thing. We have to think more about it. I've said for several weeks now, we have strategic reserves for oil. We have strategic reserves for military ammunition and equipment. We need to do that in the medical world as well. We have to be prepared to inventory the things we need when this comes up. And I wish I could say I thought this was going to be the last one. I don't think it is. I think it's going to last longer than what most people are anticipating.
Michael Neidorff, thank you for phoning in with those new measures, the CEO of Centene. Here's a look at how we finished the first session of the second quarter, first day of April on Wall Street, deeply in the red. The S&P 500 down 4.4%. The Dow losing 973 points. It was near the session lows, spilling into the close. 29 out of 30 Dow stocks lower. All sectors in the S&P lower. Hit hardest the utilities and the REITs. Still ahead, the CEO of education company Chegg will join us to discuss learning from home and the student loan provisions in the new government relief package.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Are you curious what others are listening to on TuneIn? Head to the trending section under Browse to see the most popular stations and podcasts among TuneIn listeners right now. Check it out. You might just discover something new for yourself.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wait 3 seconds.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building. But
For these and more, search sports and scroll down to the world of wrestling.
It's TuneIn Sports on this day. April 1st, 1991, Duke beats Kansas to win their first men's basketball title. Power forward Christian Laettner was named the most outstanding player.
For Laker. Sees Davis with Berry intercepts. Final seconds. Jordan without the jumper. It doesn't matter. Duke has won its first national championship.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Exciting indeed. For your free bond guide, call now. 1-800-376-4376. 1-800-376-4376.
Welcome back. Let's have a look at how we finished the day on Wall Street, lower to the tune of 4.5% for each of the three major averages. Just off the session lows, the Dow was down 1,100 points. It closed down 973 points. Russell getting hit hard, down 7%. The worst sectors on the S&P were utilities, real estate, and financials. Sarah.
Let's send it back to Mike Santoli, taking a look at momentum stocks, Mike.
Yeah, and somewhat surprising, perhaps, Sarah, owning the best performing, most popular stocks going into a nasty market collapse. Turns out it's been a great strategy relative to the rest of the market. This is the MTUM, the iShares Momentum ETF. This is S&P 500 stocks that have already performed the best on a backward-looking basis compared to the equal-weighted S&P 500. So this is momentum stocks versus the average stock, and you see making new highs. So if you happen to own those top-performing names shorting the rest of the market, you're still up. Two interpretations here. This has almost been too easy. Some people saying it's basically become even more overheated, and perhaps you need to have this strategy buckle a little bit. And in fact, it was down appreciably today. So we'll see if that develops into anything. By the way, this is basically tech, healthcare, overweighted also in utilities in the Momentum ETF. And then a somewhat related point, look at Amazon as a weighting within the consumer discretionary sector of the S&P 500. This is from Chris Verone over at Strategas. Got to 42% recently, and now just below that, around 38, 39%. It was only down half what the market was today. It shows you that Amazon obviously just consolidating its advantage in investors' minds as we look at what happens to auto stocks and the rest of retail within consumer discretionary. So we'll see if this really has anything to say about the shape of the market and the economy once we come through this crisis, guys.
Mike, great stuff. Thanks so much for that. The coronavirus relief bill giving employers a temporary tax incentive to help pay their workers' student loans off. We'll discuss that and the future of remote learning when we're joined exclusively by the CEO of education company, Chegg.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today. Like what you're listening to? Want to make getting back to it easier? Use the favorite button to keep track of the stations and podcasts you love on TuneIn. Just tap or click the heart icon to add it to your favorites. Then find all your go-to audio under the Favorites tab. Pretty easy, right?
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know. It's TuneIn Sports on this day. April 1st, 1991, Duke beats Kansas to win their first men's basketball title. Power forward Christian Laettner was named the most outstanding player.
Sees Davis with Berry intercepts. Final seconds. Jordan without the jumper. It doesn't matter.
Try it free today.
I have $1 million question for you.
There's only one Lori Grenier.
The golden ticket goes to my favorite product.
And only one...
Take it or leave it.
Shark Tank.
You're a smart man.
Shark Tank, tonight starting at 8 Eastern. CNBC, get yours.
This is the kind of card that has America talking. With it, people with Medicare are getting all-in-one coverage for their doctor visits, hospital care, prescription drugs, and more. This kind of insurance, called Medicare Part C, may also cover dental care, eyeglasses, hearing aids, fitness programs, vitamins, even healthy meals and rides to the doctor. With this kind of coverage, you do not need a Medicare supplement insurance plan. You will access your benefits through your Medicare Part C plan for one low and oftentimes $0 monthly plan premium. You deserve to get the most from your Medicare benefits. Call now for free information that may help you get more coverage for less money. There is no obligation to enroll. Whether for yourself or someone you love, call the number on the screen now. Call now.
Welcome back. Time for a coronavirus update with Rahel Solomon. Hi, Rahel.
Hi, Wolf. Good afternoon, everyone. Pennsylvania Senator Pat Toomey has been advocating for rules mandating all Americans wear masks in public to fight the pandemic. Well, Toomey now says that President Trump is, quote, sympathetic to the idea, though he did not commit to it. The Washington Post reporting federal stockpiles of respirator masks, gloves, and other medical supplies are nearly depleted. One DHS official told the paper that the supply chain for personal protective equipment has broken down and price gouging is widespread. In Israel, the government has announced that people must wear face masks while in public. Prime Minister Benjamin Netanyahu also says that upcoming religious holidays, including Passover, should only be celebrated with immediate family members. And finally, back here in the States and in New York, some New York hospitals got a helping hand from Warren Buffett. Berkshire Hathaway's private jet subsidiary let the Mount Sinai Health System 2 planes so they could pick up medical supplies in China. They brought back 130,000 sorely needed respirator masks. And as always, for more coronavirus coverage, you can head to our website, cnbc.com. Sarah, I'll send it over to you.
Rahel, thank you. Small business is certainly feeling a huge impact from the coronavirus, and we're bringing you stories of just how hard hit it has been. Russ and Daughters, a paradise for smoked fish in New York City. It's been an institution for over a century. They've never had a layoff until now. Here's fourth-generation owner Nikki Russ Fetterman in her own words.
Russ and Daughters has weathered the Spanish influenza pandemic, wars, recessions, depressions, terrorist attacks, hurricanes, but this is uncharted waters. In 106 years, we've never laid off anyone, and within a matter of days, we laid off 80 people, which is half of our staff. It's a horrible experience. I'm sick to my stomach still thinking about it. It's so hard to tell folks who have been so important to us that the least bad option is to lay them off to get unemployment, knowing that unemployment benefits, at least here in New York State, are unacceptable. You can't tell someone to shelter in place if they don't have the money to pay for that shelter or to feed themselves or their families.
That was Nikki Russ Fetterman in her own words. So many restaurants and food stores in Manhattan and across the country feeling the impact. Up next, remote learning, now the new normal all across the states. We'll hear from the Chegg CEO what his student services company is doing during the coronavirus crisis. CNBC will be right back.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Are you curious what others are listening to on TuneIn? Head to the trending section under Browse to see the most popular stations and podcasts among TuneIn listeners right now. Check it out. You might just discover something new for yourself.
Not all heroes wear capes, but most wear tights.
And here we go, guys, underway. Cover on Rowan. Wait seconds.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building. But
For these and more, search sports and scroll down to the world of wrestling.
It's TuneIn Sports on this day. April 1st, 1991, Duke beats Kansas to win the first men's basketball title. Power forward Christian Laettner was named the most outstanding player.
For Laettner. Sees Davis with Berry intercepts. Final seconds. Jordan without the jumper. It doesn't matter. Duke has won its first national championship.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
And free installation included. So it's easy. And we do it fast. In days, not months. So your space can grow as quickly as your business. See the full collection at Berry.com today.
Today on Wall Street, lower by 4.5% for each of the major indices. A little bit off the lows of the session. The Dow low was about 1,100 points, ending down 973 points. Real estate, utilities, financials, the worst performing sector. Dollar up 0.4%, yields down a little bit. We'll just mention as well, Sarah, though, that oil had a nice little run up into the close, ended up about 4.7% or so, though still $21.50. It's all relative.
Yeah, those small caps battered down almost 40% from their recent highs. Well, much needed relief brought to student loan borrowers in the relief package from Washington, the CARES Act, including allowing employers to pay off student debt without tax consequences. Our next guest has long been a major advocate for that provision, and he joins us now. Dan Rosenzweig, the CEO of Chegg. Welcome, Dan. Good to have you here. Explain why this is such a big deal.
Thanks, Sarah. Thanks, Wilfred. I hope you're all safe. It's a big deal because, well, first of all, there are two things. There's one provision that allows students to delay paying their debt for 2 months, and it's interest-free. If they continue to pay it, all of it will go to the principal, and that's good because that reduces their principal. The second thing, and something that Chegg has advocated for, and something that Chegg started over a year ago called Chegg Equity for Education, is we've decided to pay off all of our employees' student debts. One of the things we argued for was every company is allowed to give credit of $5,250 a year for continuing education for their employees, and the employees do not get taxed for that. However, if you used it to pay off their student loan, then they would get taxed for it. So there's a 1-year hiatus on that tax, which means if you were to give $5,250 for each employee that has student debt this year, you would help them pay off $5,250, and it's a really big deal. Only 13% of companies actually do something around student debt, and we've been a big advocate for this, and I want to thank Rodney Davis from Illinois, the congressman, who really helped lead this effort. He called to thank Chegg for our efforts. So it's one step. It's not permanent. We need companies to agree to do this for their employees, and then we think we can make it permanent.
Well, Dan, it's great to hear that, to hear some of the small positives in a relative sense to a lot of the negatives out there. Wanted to switch focus as well and just talk about the core business and the idea of online education. I mean, have you seen a significant uptick in demand? And do you think that that's something that will last, or is it a temporary shift whilst clearly schools are closed?
Well, Chegg was created 10 years ago with the thought that betting on the inevitable, which is that more and more students were going to have to learn. They were going to have to learn online. Eventually, the U.S. education system was going to get that, understand it. And it's unfortunate that this is the situation that has caused them to understand it. But there's no doubt that there's been an acceleration of online learning. And what Chegg does is we're not the curriculum. We're the online homework help support. So we're actually teaching people who normally would get help on campus or get help from a tutor or get help from a friend. And so we have, of course, see that in our business because more students than ever need help. 21% of all students have reported that they go to their campus help centers, whether it be for math or writing or any subject that they need help on. Now they have no access to it. And so Chegg is filling that gap quite nicely. We've been set up for this for day one, so we're able to scale with the demand, and we feel very fortunate. We're also working with a lot of big players. Verizon is one of them, where we're going to be able to provide those that can't afford our help, which is only $14.95 a month, the opportunity to get access for a couple of months of Chegg for free so they can finish their semesters. No students had to do this before. And so we want to be there to help those students. And we're really grateful for our team, our companies working round the clock to provide that.
You mentioned sort of the financial hardship that students have. We've been going in and out. I mean, obviously, the online education is at all levels. But so if you do have a lot of student loan debt, what's the best advice, Dan, right now, how to sort of take advantage of some of these new provisions? Is it just to not make those payments for the next few months because you're not going to accrue interest and get higher debt loads?
I think if you have expenses, and most college students do, I mean, you have to understand the average age in this country of a college student is 25. 40% of them work 30 hours a week or more. 36% of them claim to be hungry over the course of the month. And so we recommend that they take care of themselves first. If they happen to be better off and they can pay, if you pay it now, it reduces the principal, and that's good for you. But honestly, they got to think about their physical health. They got to think about food. They got to think about completing their classes, and they got to think about their mental health. And so we just recommend that they do whatever they need to do for themselves. It's a 2-month benefit. Honestly, I believe there's going to be another stimulus. And I do know that a series of congresspeople and senators are arguing for particularly on the Democratic side in this time, to be able to eliminate at least $10,000 a year of debt. So we want to make sure that students do whatever they need to do.
Wow, that would be another step forward. Dan Rosenzweig, thank you for joining us. Love the Springsteen
right,
poster. Good to see you.
That's my home. Thank you. Stay safe.
Former Guitar Hero CEO as well.
You
I had not realized that as part of my research. Time for our daily good news rundown, highlighting the positive stories out there in spite of the pain of the coronavirus. Live Nation launching a $10 million fund to support concert crews. The Crew Nation Fund will provide monetary relief for those impacted by the virus amid widely cancelled concerts, festivals, and other live events around the world. Home Depot says no longer will the N95 respirator masks to general public, but instead will donate them to hospitals.
Kroger now providing all hourly frontline grocery, supply chain manufacturing, pharmacy, and call center associates with a hero bonus, they're calling it. It's a $2 premium above their standard base rate of pay. Comcast, our parent company, CEO Brian Roberts pledging $500 million for employees whose jobs are impacted by coronavirus. Roberts adding that he and other top Comcast executives will be donating 100% of their salaries to charities to support coronavirus relief efforts. And of course, a reminder there, that is the parent company of CNBC. Pop star Taylor Swift supplying a Nashville record store with money for each of its employee and 3 months worth of health care. This after Grammy's new and pre-loved music had to send its employees home after the city's mayor issued a stay-at-home order.
I mean, Sarah, every day...
Maybe our producer, Chris, had something to do with that. Who's a huge Taylor Swift fan.
That story getting in there.
Rundown.
Well, no, but
good for her.
I was going to say, all jokes aside, every day you and I always talk about how much we love this segment. And the other encouraging thing is every day we come in the morning and I think, are we going to run out of stories to put in this segment? And by lunchtime, we already have too many to include. And I do think it's important to continue to applaud all these corporations whose original kind of raison d'etre is to make money doing things like this, which are clearly in the opposite vein, and they should be applauded for it.
Well, and I think it also shows you that innovation can be born during crisis. You can turn a factory from making men's shirts and bow ties like Brooks Brothers into making, surgical masks and all of these other sort of examples, which are really fascinating to see what American companies can do.
Absolutely.
Anyway,
Absolutely.
Up next, thousands of homeowners are already struggling, as we've been talking about, to make their monthly mortgage payments. April 1, bill comes due. We're going to talk more about what happens next when we come back.
Did you know TuneIn doesn't just live here on your smart speaker? From the audio that moves you to the audio that gets you moving. Soundtrack your every movement with the free TuneIn app. Available on your phone or tablet. Download TuneIn from the App Store today.
Get social with TuneIn. Follow TuneIn on Facebook, Twitter, and Instagram to discover what's happening in the app and around the world. Be the first to know about upcoming games and the hottest new music. Follow @TuneIn and always be in the know. It's TuneIn Sports on this day, March 27th, 1988. The Chicago Bulls and Atlanta Hawks match up in the Georgia Dome in Atlanta. Now, it draws a crowd of 62,046, the largest in any game in the NBA history. And the Bulls win 89-74.
But there's no question the spotlight today will focus on Dominique. Given what happened last week, I would think there's some incentive for Dominique
to listen to conversations breaking down the moments just like this. Click on Sports to be part of the discussion on TuneIn.
Are you curious what others are listening to on TuneIn? Head to the trending section under Browse to see the most popular stations and podcasts among TuneIn listeners right now. Check it out. You might just discover something new for yourself.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wins.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of the latest WrestleMania, turn on the WWE podcast. Or listen to the Steve Austin Show for no-holds-barred conversations with wrestling's biggest personalities.
It's good to be here tonight. It's an empty building. But I'm
For these and more, search sports and scroll down to the world of wrestling.
Huh. Forgot my glasses.
ServiceNow, the smarter way to workflow.
Before the first trades, the latest updates on coronavirus impact.
Our focus, of course, on the economic crisis, on the health crisis, and on the equity markets.
Squawk on the Street, 9 a.m. Eastern. Watch and listen live on the CNBC app.
Welcome back. The Fed just announcing a temporary change to relax bank capital rules. In particular, they are changing the supplementary leverage ratio to ease strains in the Treasury market. So the supplementary leverage ratio essentially speaks to how much core tier 1 capital the banks have to hold. The banks over 250 billion in assets have to hold 3% of that type of capital. The G-SIBs, the globally systemic important banks, have to hold 5%. This is going to reduce the amount of that sort of capital they have to hold. They're going to exclude Treasury securities and deposits from the calculation. Essentially, again, going back to my point, lowering the amount of core tier 1 capital they have to hold. Just in the statement, just a couple of quotes I'll pull out there saying liquidity conditions in Treasury markets have deteriorated rapidly and financial institutions are receiving significant inflows of customer deposits. Jumping forward, it says the change to this SLR will mitigate the effects of those reductions and better enable firms to support the economy. Mike and Sarah, I know obviously both aware of this. I mean, clearly the Fed has done so much over the course of the last couple of weeks. This is quite a high-profile individual move and clearly very targeted to the banks. But accompanied with everything else we've seen, it just shows that they are listening. It goes along with what James Gorman was saying to us earlier. They're ready to act. I guess you could say this is a little bit more significant as an individual step than some of the others, and it comes at a point when we'd hoped the worst stress was behind us, but all in all continues a broader theme of they're listening and they're addressing the problems when they see them.
Right. I mean, the Fed is essentially saying we've done this much. We've essentially cleared a bunch of blockages in the system, and let's see where other clogs develop. And so essentially it's allowing banks to more easily hold treasuries and deposits on their balance sheet and just not have to reserve capital against them. Therefore, they'd be more willing to both own and make markets and treasuries. So it should liquefy the system a little bit, and I think that's what they're after.
All right, guys, we want to hit the mortgage applications numbers today. Another big story because mortgage apps to buy a home fell dramatically last week as home shoppers pulled back. And those who do own a home, some of them are already having trouble making that monthly payment. Diana Olek here with the details. Diana.
Yes, Sarah, the calls are flooding in. The CEO of Caliber Home Loans, which services 750,000 government-backed loans, said they had over 8,000 calls on Sunday alone, people asking for help. The government forbearance program allows borrowers to miss up to a year's worth of mortgage payments, which are then tacked on to the end of the loan. Now, I spoke with the regulator for Fannie Mae and Freddie Mac, Mark Calabria, who estimated as many as 2 million borrowers would apply for forbearance by May, and the numbers will likely go much higher the longer it takes for the economy to reopen. The forbearance program does not require borrowers to show any proof of hardship. Calabria admitted they're working on the honor system. Back to you guys.
Thanks so much for that, Diana. We've got a minute left of final thoughts. And guys, clearly a big sell-off again today, down 6% or so for the worst performing sectors, 2% for the best performing, 4.4 overall for the market. And Mike, as we got that announcement from the Fed, there clearly are some technical issues they're still worried about, but they are listening and throwing everything at it.
Right. I mean, you have multiple players just trying to kind of sit on cash. They're not as willing to put money at risk or to make markets. So this should theoretically loosen things up a little bit. Now, as for the stock market, you did get what many would have thought is a predictable pullback after that bounce yesterday. I'll just say 20% bounce off the low last week didn't mean that the low was in. 6% decline since Thursday doesn't mean it wasn't.